The oil market is no stranger to volatility. Over the years, we've seen prices soar to unprecedented heights and plummet to unexpected lows. This roller coaster ride is influenced by a myriad of factors, making it one of the most unpredictable markets in the world. Prices can swing wildly with geopolitical tensions, natural disasters, and economic uncertainty. A single event, whether it's a hurricane disrupting supply chains or a political conflict in a key oil-producing region, can send shockwaves through the market, causing prices to fluctuate dramatically. But the plunge on April 6, 2025, sent shockwaves through the industry. This wasn't just another dip, it was a significant event that caught the attention of traders, analysts, and policymakers alike. The sudden drop was unprecedented, leaving many to wonder what had triggered such a dramatic fall. Oil prices experienced their most significant single-day drop in months. The charts showed a steep decline and the trading floors were abuzz with activity as traders tried to make sense of the situation. The market was in turmoil, and the ripple effects were felt across the globe. The culprit? Many analysts point their fingers squarely at the reimposition of tariffs by former President Donald Trump. His decision to reintroduce these tariffs was seen as a major factor that disrupted the market, leading to the sharp decline in oil prices. The move was controversial and sparked a lot of debates among economists and policymakers. This wasn't just a blip on the radar. The impact of the tariffs was far-reaching, affecting not just the oil market but the broader economy as well. Analysts were quick to point out that this could have long-term implications, potentially leading to a period of sustained volatility. The decline marked a continuation of a downward trend that had been brewing for weeks. The market had been showing signs of weakness, and the reimposition of tariffs seemed to be the tipping point. Analysts were now closely watching the trends, trying to predict what might come next. The energy sector, already grappling with a shifting landscape of renewable energy and climate concerns, found itself in a new kind of turmoil. The push for cleaner energy sources and the growing awareness of climate change were already challenging the traditional oil industry. Now, with the added pressure of market volatility, the sector was facing unprecedented challenges. Investors were left scrambling, trying to decipher the potential long-term implications of this latest economic curveball. The sudden drop in oil prices had created a sense of uncertainty, and everyone from small investors to large financial institutions was trying to navigate the turbulent waters. The future of the oil market seemed more uncertain than ever, and the world was watching closely to see what would happen next. Former President Trump's return to the political stage in recent months has been anything but quiet. Amongst a flurry of executive orders and policy reversals was the reintroduction of tariffs on goods imported from China and several other key trading partners. These tariffs, a hallmark of his previous administration, have long been a point of contention among economists and policymakers. Proponents argue that tariffs protect domestic industries and jobs. Critics, however, counter that they disrupt global trade, increase costs for consumers, and ultimately harm economic growth. The reimposition of these tariffs, coming at a time of already heightened global uncertainty, sent a ripple of anxiety through the interconnected web of international commerce. To understand the impact of tariffs on oil prices, it's crucial to grasp their broader effect on the global economy. Tariffs are essentially taxes on imported goods. When one country imposes tariffs, it makes those goods more expensive for businesses and consumers within that country. This can lead to several knock-on effects. First, it can reduce demand for the imported goods, hurting businesses in the targeted countries. Second, it can lead to retaliation, with the targeted countries imposing their own tariffs on goods from the original country. This can escalate into a trade war, where both sides keep raising tariffs, creating uncertainty and disrupting global supply chains. So how do tariffs, which primarily target physical goods, impact something as seemingly unrelated as oil prices? The answer lies in the interconnectedness of the global economy. When tariffs disrupt trade and create economic uncertainty, they can dampen overall economic activity. Businesses may become hesitant to invest and expand, and consumers may cut back on spending. This slowdown in economic activity translates to reduced demand for energy, including oil. The logic is simple. When businesses produce less and people travel less, they need less energy to fuel their operations. Section 5. A nervous market reacts. The oil market, always sensitive to shifts in supply and demand, has reacted nervously to the reimposition of tariffs and the specter of a global economic slowdown. This reaction is not unexpected, given the market's history of volatility in response to geopolitical events and economic policies. The reimposition of tariffs has created a ripple effect, causing traders to reassess their positions and strategies. The uncertainty surrounding future trade policies has only added to the market's anxiety. The price of Brent crude, the international benchmark, fell to $X a barrel on April 6, 2025, a significant drop from its recent high of Y dollars just a few weeks earlier. This decline is indicative of the broader market sentiment, which has been increasingly bearish. Analysts have pointed out that the drop in Brent crude prices is also a reflection of the anticipated decrease in global oil demand. The market is bracing for a potential slowdown in economic activity, which would inevitably lead to lower consumption of oil and other energy resources. Similarly, the price of West Texas Intermediate, the U.S. benchmark, also experienced a sharp decline. This drop mirrors the trends seen in the international markets and underscores the interconnected nature of global oil prices. The U.S. market, while somewhat insulated, is not immune to the effects of global economic policies and trade tensions. The decline in West Texas Intermediate prices has raised concerns among domestic producers and investors, who are now grappling with the potential impact on their operations and profitability. These price drops reflect the market's concerns about future demand. Financial analysts have been vocal about the potential risks, highlighting the uncertainty surrounding future economic growth. The market's reaction is a clear indication of the lack of confidence in the current economic climate. Investors are wary of the potential for a prolonged period of low demand, which could have far-reaching implications for the oil industry and the broader economy. Investors are essentially betting that the economic uncertainty caused by tariffs will lead to lower oil consumption in the months to come. This sentiment is driving the current market trends, with many investors opting to reduce their exposure to oil-related assets. The ongoing trade tensions and the potential for further economic disruptions have created a challenging environment for market participants. As the situation continues to evolve, the oil market will remain a focal point for investors and analysts alike, who will be closely monitoring developments and adjusting their strategies accordingly. Section 6. Echoes of the Past, Tariffs and Oil Prices. This is not the first time that tariffs have cast a shadow over the oil market. In 2018, the Trump administration's trade war with China contributed to volatility in oil prices. The uncertainty surrounding the trade dispute, coupled with concerns about global economic growth, weighed heavily on oil markets. While the situation today is not identical, it bears striking similarities. The reimposition of tariffs has once again raised concerns about a trade war and its potential to derail the global economy. History, as they say, may not repeat itself, but it often rhymes. Section 7. The Analysts Weigh In. Market analysts and economists are divided on the long-term impact of these tariffs on oil prices. Some believe that the price drop is a temporary blip and that prices will rebound once the initial shock wears off. They argue that global oil demand remains robust, driven by population growth and rising living standards in developing countries. Others, however, are more pessimistic. They point to the potential for a prolonged trade war and a significant slowdown in global economic growth. They warn that if demand weakens substantially, oil prices could remain depressed for an extended period. Section 8. The Road Ahead. Uncertainty looms. The future of oil prices remains uncertain. Much will depend on how the current trade situation unfolds. If the U.S. and its trading partners can resolve their differences and avoid a full-blown trade war, the impact on oil prices may be muted. However, if the trade dispute escalates and global economic growth slows significantly, oil prices could face further downward pressure. The energy industry, already navigating a complex landscape of technological advancements and climate concerns, will need to brace itself for continued volatility. Section 9. Conclusion. A complex equation. The recent drop in oil prices, fueled in part by the reimposition of tariffs, has sent ripples through the global economy. This decline is not just a simple market correction but a reflection of deeper, more complex dynamics at play. The tariffs, aimed at protecting domestic industries, have had the unintended consequence of disrupting global supply chains and altering the balance of trade. This situation underscores the intricate and often unpredictable relationship between trade policy, economic growth, and energy markets. When tariffs are imposed, they can lead to a cascade of economic reactions, affecting everything from consumer prices to international relations. The oil market, being highly sensitive to geopolitical shifts, reacts swiftly to such changes, often in unexpected ways. It serves as a stark reminder that in our interconnected world, no policy decision exists in a vacuum. The global economy is a web of interdependencies, where actions in one part of the world can have significant repercussions elsewhere. This interconnectedness means that policymakers must consider the broader implications of their decisions beyond immediate national interests. Seemingly isolated policy decisions can have far-reaching and often unintended consequences. For instance, a tariff intended to protect a local industry might lead to retaliatory measures from trade partners, sparking a trade war that affects global markets. The domino effect of such policies can be profound, influencing everything from employment rates to the stability of financial markets. As we move forward, it will be crucial to closely monitor developments in the trade arena. Analysts and policymakers alike must stay vigilant, tracking changes and anticipating their potential impacts. This requires a deep understanding of both the economic theories at play and the real-world data that can signal shifts in the market. Assessing their potential impact on the global economy is not just an academic exercise but a practical necessity. The health of the global economy hinges on the delicate balance of numerous factors, including trade policies, market demands, and geopolitical stability. Each of these elements can tip the scales, leading to either growth or recession, and in turn, the delicate balance of oil supply and demand. The oil market is particularly sensitive to these shifts, as it is influenced by both immediate supply concerns and long-term demand projections. Changes in trade policy can alter the flow of oil, affecting prices and availability in ways that resonate throughout the global economy. The road ahead may be uncertain, filled with potential challenges and opportunities. Navigating this complex landscape requires foresight, adaptability, and a willingness to engage with the global community. Businesses, governments, and individuals must all be prepared to respond to changes and seize opportunities as they arise. But one thing is clear, the price of oil will continue to be a key barometer of global economic health. As we look to the future, understanding the factors that influence oil prices will be essential for making informed decisions. Whether it's through policy adjustments, market innovations, or international cooperation, the goal must be to maintain stability and promote sustainable growth in an ever-changing world.